All right, so welcome everyone to what is this? The third session, but probably going to be the second uploaded one. I'm trying out a new format here where I'm stuck in the corner, and not the main part of the video. Thankfully for everyone's sake, there. And I've been using this new app, and I've been actually really loving it. It's called Excalidraw, and really gives me that old Khan Academy vibes, right? Where Khan would like go and draw all that stuff, and I felt like this would be a really great throwback, to be able to do some educational content in that manner. As I fudge it around with my stylus here to write you a nice hi message here. It works. So cool. Or hopefully it works. I mean, I'm trying this out. If it doesn't work, then this will probably never see the light of day. But if you're seeing it, that means that this is somewhat successful. And so today's lesson is going to be about really diving into how VCs, run their fund and the typical investment cycle that these fund managers will go through. I think that this will really, my goal in this is to give a lot of entrepreneurs and founders who are looking to fundraise a little peek behind the curtain so they can understand on the other side of the table what are VCs going through, what are their objectives, goals. So hopefully that'll help in aligning what founders can do in their pitch strategy, in their engagement strategy, all those different types of things. So, right now today we'll probably just be looking at the VC side of things, and then maybe next week we'll probably look at, like, as an entrepreneur, how do you take advantage of that? So it'll kind of be the two-part series there. So I think a really great place to start with is looking at the kind of hierarchy of a venture fund, right? And so just like every company, every organization, big, small, they may have all of these positions. They may just have one or two of them, but I'm just going to list them all out. I'll go into which ones are the main ones, which ones are kind of minor. There's a lot of different dynamics between the sequoias versus first-time fund managers. So I'll try to be, somewhat general to start and then drill down deeper. So what we're kind of looking at is kind of the VC totem pole here. And let's make this a nice, this color here. And let's just zoom in and make that front and center here. And so, when we think about like the totem pole, let's start with a good, strong fundamental base. Some firms may have these individuals, associates, and let's give them a nice pink color, maybe, because they're kind of fresh and raw in the industry. Generally these people are trying to break into the VC industry, into tech, maybe in general, new MBAs and the like. And then you have maybe some more, technical or more finance focused folks. These are the analysts. These two kind of round out analysts. They're understanding market data. They're investigating different investment trends that are ongoing, new technologies that are arising, also different financial arbitrage opportunities if you're looking at it from a business end. So there's really a lot of science and math going on with the analyst side, as the name implies. And for associates, they're running day to day. They may be doing things that the partners, they're too busy to be able to handle themselves. We'll go into the partners a little bit later, but just think about, hey, these are new people trying to come into a venture firm. They might be trying to reach out, getting pitch decks from companies, doing that initial, very shallow level diligence on these companies, maybe listening to a couple pitches. Depends on the firm. We'll go into that a little bit more detail later, but just kind of level setting. These are two of the foundational level parts of the totem pole. So as you go up a little bit higher, and I'll kind of skip a layer here because I think it'll make more sense. So we'll just have partners in general. And, a little bit above them, we have founding slash managing partners. So there's a two-step hierarchy here. Some firms just have all partners, especially if, it's a small firm or whatever. And let's make this kind of a nice, this green and these ones this green. The reason for these two being green is because two founders and any startup in general, these are the people who have kind of the investment authority. In most, probably 99% of cases, these are all the folks who are going to be making the actual investment decisions. Really, quote unquote, writing the check, sending the wire. These are the people who have execute authority on that. So really, when you're thinking about like the be all end all at a venture firm and who are the people who you need to get in your corner, these are the people to do it. A lot of firms work off of unanimous consent, so you need to be able to have every single one of these people, really involved and understanding your business and really liking what you're putting down. So the difference, managing partners might be above partners in some logistical pecking order, right? That managing partners are able to sponsor a deal, to come together for a grand partner meeting. We'll go into more detail on what that means, but partner meeting is just when all of the partners in a firm come together, listen to different pitches, or post listening to a pitch. They'll come together, discuss all the pitches that they've listened to and which ones they want to do some diligence on. If they've already gone through diligence, which ones you want to invest in, which ones where you might want to, maybe get a little more updates. We want to see where the business progresses, in the next quarter or so on. Need a little bit more information. And so during those partner meetings, right, it's unanimous consent oftentimes where all of the partners will come together and vote. Managing partners and founding partners may have more power to be able to dictate what happens in the meetings, and may have different structures for sponsoring a deal or who presents a deal, and it might only be a managing partner. But in some firms, lower level partners who been promoted into it or been hired after an initial founding team of partners, they are now able to sponsor a deal. It just depends on the firm, their culture, something that a founder's responsibility to educate themselves on. So cool. In some firms that are bigger, you might have people who are not quite partners yet. They're known as principals. Some of them may have investment authority, but just imagine being kind of an associate plus. And oftentimes, another name for some of these folks might be directors, and managing directors are kind of a interesting deal. They run kind of the operations. Think of like a COO for the venture firm. And you might have directors who are in marketing, who are in platform. They're doing very specific things. They may not be part of the investment flow. They may have some influence, and we'll discuss that a little bit more in a second. But, at these larger firms, you start having, you're scaling your venture firm just like you're scaling a startup. And so, you start adding more of these specialized executive leadership roles in. And they may be able to, depending on, again, the culture of the venture firm and how the process is, they may be able to sponsor a deal into the partner meeting. They may be kind of, a partner in a sense, right, where they're able to have a vote. But very generally, principals and directors, they generally, principals maybe more so, may have some investment authority. Directors, very often I've seen, do not have it. They're more for very specific tasks that need to be done at a firm, and projects and things that they're managing. So let's give them a different color, maybe a nice blue color there. And so I left this little space here, and these are the apex of the VC power structure here. These are the LPs, and maybe I'll just write the full name out. So limited partners, And so, again, you might be thinking like, oh, more partners. What's different about these people? So limited partners are people who invest into a venture fund. VCs very often do not contribute the majority of the fund. In fact, it's probably going to be like 95% money from just limited partners. Limited partners, in the name, they have limited actual on paper power, but in the fact that they're giving money to a venture firm, really have this kind of extreme soft power to be able to dictate what a venture firm does, because they're giving basically, by providing that investment, they're giving approval to the partners, these general partners at a venture firm, the ability to execute on their investment thesis. And by investing in a future fund, in a fund two, through whatever, basically giving their support and approval for past investments made. And so the LPs are at the top of the totem pole. VCs are constantly trying to find and butter up new LPs. It's just part of the game. So, VCs, you think that they're sitting on some, incredible pile of money, and, they're lording over everything. Well, everyone has their master at some point. And so in this case, GPs, general partners at venture firm, they're beholden to their LPs. If, they piss off their LPs, they don't get money for a future round, they close down their venture firm, right? And so that's why in the pecking order, they're at the top. VCs are always thinking about, how do we attract more LPs in the future? How do we get on value add LPs if you're in the privileged position to be able to do that, where the LPs are able to be helpful to the venture firm in some particular way? Limited partners can be individuals providing their own capital in, and not excluding any other outside group, but these include institutions, schools, endowment funds are popular examples. You might have family offices who are investing on behalf of a family in a state. And sovereign wealth funds. There's all these different types of people who may be potentially limited partners in venture firms. Very often, we talk about needing to drive change in the venture industry, and really, GPs are just doing what LPs want them to. When you're thinking about who do VCs serve, at the end of the day, the top on their list, where customers are the top of startups list, like we should be serving customers as startup founders. For VCs, they are serving their LPs, trying to return capital and trying to, obviously, 100x the amount of money, trying to generate as great of returns as possible. So great. We've kind of listed off some of the main different positions at a venture firm. So we're just trying to make a nice grouping of this. And let's just use the same colors to do the grouping. So again, we have these folks here, the analysts and associates. Make that transparent. There's a grouping there. Let's just copy paste that. There's a grouping here. I'll just kind of group these together here. And I'm working with a limited set of colors. If there's another green, I guess the real green folks who are deserving of the green highlight is probably the LPs, since they actually provide the money. But in a general outward sense, a lot of people just think about the GPs here as having the real money power. But in case, I'm just going to move these over here so that the totem pole looks a little bit better. Everything's too straight. There we go. So we're just gonna provide a bit of labels here. So the LPs, in the sense of the VC totem pole, collectively, they're essentially gods, right? You know, they are whatever they dictate basically needs to go with the VCs. There's something called a limited partner agreement, an LPA, where they basically lay out what the venture partners can do. And, let's just say that there's a market downturn, right? And there are things called capital calls where basically GPs, they're about to execute an investment. The money is not sitting in a bank for them to do so. It's not like they put it in escrow. The LPs don't put the money in escrow for the venture partners to use. There's capital call requirements. They're pulling money. They're basically getting a wire from people, the LPs, and then are wiring those to the founders. So if you ever wonder why there may be a delay on, money being wired from a venture firm, in some cases it's in the hands of their LPs, right? And LPs may be busy. They may be, the CEO of some major company, and they'll only check their personal email or whatever email they gave to their, the venture firms that they've invested in. And, maybe they have an accountant or a financial advisor who deals with that type of stuff on their behalf. But, very generally, have a little bit of patience for VCs. They may or may not deserve some, but, in some cases. But in the case of actually wiring the money, there are logistics reasons, waiting for the wire to clear. That might be a problem with the bank, so on and so forth. But, this is the one case where, I'd advocate for a little bit of patience on the VC's group on behalf. So just labeling this group. So, I'm going to use the term generally equal decision makers. A little soft pun on the fact that these folks are considered GPs, general partners in a legal sense. And so, they're generally equal. Again, promoted partners or hired partners, there might be some cultural two-step hierarchy there. In some cases, some firms trying to get everyone on the same page, right? It's down to the individual culture of the venture firm. So when you're, looking to pitch and, start negotiation and diligence with a firm, and you're trying to understand what's going on, talking with other founders who have received an investment from that firm, might give you some good insights into the political structure, the internal political structure that's going on inside the venture firm. And that might give you a little bit of insight into when you're pitching, who do you focus on, who do you talk to, who do you need to butter up perhaps a little bit more. It's all that part of that fundraising game where you need to figure that stuff out and, try to maneuver your company through the process, through the VC's culture as swiftly and as painless as possible. For the principals and directors, at a larger firm, so at a larger firm, they may have investment power, but generally, in my experience, probably not. Maybe the principals do at the largest of firms, but generally, principals, are just higher powered associates who are able to raise stuff to a partner meeting and participate and all that type of stuff. It's just setting up the hierarchy. That being said, right, they may have some influencing power, but from a general sense, generally have some investment influence. They may be able to shepherd your deal through, but by and whole, they may not be the people who are able to help in pulling the trigger. And so basically, we reach the foundational stack of the totem pole here. And these are folks who have minor to no influence, but conversely, they may be more approachable. And just consider them as like kickstarting in investment process. For a lot of founders, they may get excited if a associate reaches out to them, but just keep in mind they have, in 99.9999% cases, they can't make an investment decision. Their word means maybe a little bit, but probably not a lot. It's generally the partners who, you need to be convincing. An associate, the, in my experience and being an associate in the past, it's pretty easy to get us excited for deals and get us to get it in front of a partner. So, maybe consider it like a speed bump or, the open PO box at a company. They're there to help you get your foot in the door, but once you're in there, you got to deal with the partners. So don't waste too much time with the associates and analysts from a founder point of view there. All right, so zooming out and maybe moving over to this side of things, and I'll try to release the full thing as like a whole picture. But right now, let's think about like what should I name this? The VC lifecycle. Make it bigger. Make this a nice bright color, just to let everyone be able to see it. Maybe make it even more bigger than what they allow me. There we go. So we're going to be talking about the VC lifecycle here. And so, the VC lifecycle actually, funnily enough, starts pretty similarly to a startup, where your first step is probably just finding, like-minded partners in this, right? So you might have worked with some folks at a prior startup, or have worked with a bunch of people in a venture firm, networked with a bunch of people, all those different types of things, where you're like saying, hey, we may be actually really good fund managers, people who can be good stewards of other people's monies and be able to find really great startups and invest in them. And we have some particular unfair advantage through our knowledge, work experience, entrepreneurial experience, founder experience, that gives us an edge compared to other fund managers in being able to generate strong returns to prospective LPs, right? And so, I'm just kind of creating a little box for this here, finding these like-minded founders. We'll just color this, give this a nice background color, and send it to back. Nope, that's the opposite. Send it to back. Just like a startup, you're finding your co-founders, right? And co-founders in this case for a venture firm. Cool. And so, when you're starting a venture firm, what are some of the considerations to think about? Well, on one hand, and let's make this a nice green here, you need to raise your fund, right? So for the most part, these partners, called GPs, they're not investing too much of their own capital, or their capital does not make up the vast majority of their fund. Probably will make up around 5%. It's called a GP commit. Kind of one of the barriers to get into VCs, but generally a lot of LPs want to know that these GPs have a little bit of skin in the game, that they're not completely gambling, if you will, on someone else's money. They're not making bets on startups with purely other people's money. They want to know that these GPs have a little bit of skin in the game, a little bit of risk that they're taking on themselves. In some cases, right, it's a little bit discriminatory in some ways when people aren't able to afford GP commits, right? GP commits can be around 100,000 to $500,000, depending on the size of the fund. Usually it'll just say like, hey, it's a 1 to 5% GP commit based off of the fund size. So as you can see, right, you're leaving a range of 99 to 95% of money that needs to be generated from the outside capital being raised. Sounds kind of familiar from a startup perspective, right? Very rarely will a venture firm be completely bootstrapped. You might have some of those unicorn founders who create their own venture firm, and they are their own LPs in some sense. But for the most part, most fund managers are not, creating large, massive, uh, capital commitments to their own venture firms. If they would do that, they'd probably do it in a family office format. But that's a conversation for a different day. So right now, you're thinking about raising a fund, um, a little bit of something tangential, but is somewhat important. If you were thinking about like how do VCs make money, they also not just raise the fund being, what they literally use to invest in startups, uh, but they might also need to raise a management company. So this is usually an LLC that goes alongside the different SPVs that form the investment vehicle for the funds. The management company is basically the day-to-day salaries and any costs incurred by the VCs in their doing their business, going to conferences, their offices, the associates that they need to hire, so on and so forth. That is all coming from the management company. And generally, that's where, you negotiate with the LPs. Hey, I'd like to collect $100,000 salary. That seems like a good and reasonable amount. Or if you're, a first-time fund manager, you might tailor down that salary to potentially not even taking a salary. And you might be incentivized on carry and carried interest. You might have heard that term in investment. Carried interest from a venture perspective, generally is some form of return that the partners themselves and potentially the firm will take from any exits that occur based off of the investments that they've made. So, if your fund just recently in the news, Figma, great acquisition to Adobe. If you made an early investment into that as, during their Series A when they were pretty flat, probably huge, massive exit, you might get a 2% carried interest as the partners who invested on behalf of the LPs. The LPs are willing to give you, it's in initial negotiation, you will solidify the carried interest number, 2% back to the GPs, and that, if it's a huge acquisition in the billions like Figma, and the venture firm got in early or kept invested in a good amount, and were able to create a strong position there, that's life-changing money potentially for a venture partner. So when you think about it from that perspective, right, the compensation goals of a venture firm, yes, it's nice for them, using some baseball terminology here, you would think that they would really like to, just get on base, hit singles, doubles, triples, but really with carried interest, their incentives lie in wanting to hit as many home runs as possible. It generally, carried interests on, small time acquisitions, that's like a single, maybe larger acquisitions, that's kind of a double, and then maybe some soft IPO, moderately to high acquisitions. You're thinking in the millions acquisitions, 9 digits, that's like a triple. You just take away 1 digit from the figures. 8 figures, double, 7 figures below is a single. It really is in the interest of the VCs to be able to hit home runs, the $1 billion. You start getting into that amount, that could be life-changing, generational wealth for a VC. So going back to raising a fund, right? So we had talked earlier in the episode, where does all the money in a fund come from? Comes from the LPs. So you need to pitch to LPs as a prospective fund manager. And whenever you're raising a fund, you'll have to pitch to LPs again. Limited partners, rich people, rich organizations who are able to provide capital and you're basically convincing them that, them putting their money in, let's say the standard benchmark, the S&P 500, we can achieve alpha, a higher set of returns than is more likely within a 10-year time horizon than the S&P 500, which is generally considered a good benchmark. There's a lot of things to consider from a venture perspective. So you might be wondering, like, hey, if the stock market goes down, why should that matter to VCs? Public and private markets shouldn't be correlated, right? Well, when the money comes from LPs, the public market then matters because a lot of these LPs, they're probably liquidating positions in the public markets to be able to provide capital for VCs to invest in. And so that's where the correlation comes from. At the time of this recording, the public markets are getting shellacked. And so LPs are losing a considerable amount of money. And so their risk tolerance goes down. They do not want to be putting money into, risky assets like startups or having venture, VCs do it. So even if there is a commitment made by an LP to a venture firm, and technically by law, the VCs can sue for it, by the fact that you want to be on LP's good terms, VCs will take into consideration the amount of capital that these LPs are willing to do. Just wait for a better cyclical cycle. When the market recovers, LPs feel more comfortable to invest again, and that's where VCs will start deploying capital again. So you might see some correlation there, right? Top tier funds, and generally, if these fund managers were good stewards of capital and kept some dry powder going from some amount of LPs, you're not, deployed 80% of your fund and you have 20% remaining. The LPs might be like, you've already deployed enough. We don't really want to deploy the last amount until things get a little bit better, calm down a little bit. I'm not hemorrhaging money in the public markets. Let's say you've only deployed 30 to 40%. You go into that. Well, the LPs some of them haven't heard from you. And so when you make that capital call on them, they might be more likely and willing to, wire the money. So cool. Venture funds, given that they have to pitch to LPs, will probably need some form of a pitch deck, right? Like a startup. But in the case of, these venture firms, they're not necessarily pitching their startup or yikes, I'm struggling in saying this. Yikes. All right. Doing the pitches to LPs. So what's going on is that, for a venture firm, they need to present their investment thesis. What is an investment thesis? These are a set of guiding principles that the VC is laying out to LPs that they're going to be investing in a certain space, industry, vertical, so on and so forth. They're going to be investing in this stage of company, pre-seed, seed, Series A, and these type of founders in some cases, right? There are more and more minority investment funds. There are female investment funds there that are focusing on investing in females, investing in minorities, investing in LGBTQ founders, right? Some in different countries, so you might have geography that is a consideration inside of an investment thesis. All of these investment theses are basically to say that, hey, we as GPs are great stewards of capital. We are going to be great fund managers. These are the unfair things that our personal experiences and what we know and what we're good at basically allow for us to achieve higher returns compared to other venture firms, compared to the public markets, and compared to just investing directly into a single startup themselves. This is why we're better, why our strategy and our thesis is better, right? And some of the things that venture firms often talk about when they're talking about their investment thesis, the amount of risk that they're taking in. Later stage firms, lesser returns, but more, lesser returns, less risk, right? More risk, more returns. it makes sense, right? If you are investing in pre-IPO companies, these companies are probably going to make it. Probably a lot of them are not going to be shutting down. It's probably the strategy of the fund is to make an arbitrage play that basically, in their Series E, F, those later stage D through F um, fundraising rounds, um, that when these companies IPO, there's going to be a sizable valuation gap between the time that they've gotten their last priced round to their initial public offering, where that's a liquidity event for the venture firm, and they can book a nice solid win in between, the arbitrage between that priced round and the IPO price. And so let's just note this down here. So you have your investment thesis and strategy. And so, another thing, you might be talking about underserved industries. So industries that people, generally may or may not be looking at, and that you may have some unfair advantage in being able to understand it, right? And so, let's just say that, in the current environment right now, right? Synthetic biology seems to be a really strong trend at the time of recording this. Crypto is kind of on the downswing, but now you have a lot of natural language processing applications, a lot of generational AI that's kind of in vogue right now. You have, DALL-E, GPT-3 that are kind of in vogue. Those are really highly technical things. And so being able to say that you have a background in NLP, background in generational AI, background in biology, biotech, might give you an unfair advantage as a venture firm in being able to evaluate different startups as compared to, a bunch of financially focused fund managers who they may be great at being able to crunch the numbers. For a lot of these deep tech companies, they're on paper, their numbers are not going to be looking great. The hockey stick is truly real for them. Once they hit the inflection point, a lot of the value that a venture firm can derive through an investment is mildly lost. I would say that maybe there's a little bit of, some exponential growth that you can get, but once a company starts taking off in deep tech, later stage people who want to invest in them, they're probably going to be getting a worse deal as opposed to when the company is going through their R&D, they're trying to figure things out. As a GP, if you have some unfair advantage, some knowledge, some prior background that allows for you to evaluate and say, hey, these people are onto something. This is a new approach. I haven't seen this out in the market, and this could be something cool. That could give them a deep insight into picking startups that are more likely to succeed in these particular areas. And look, I kind of went to a deep tech example there. That can also be the same thing for, let's say, enterprise SaaS. You've worked in Fortune 500 companies for your entire career. You know strongly how the acquisitions process works there. What are the needs and wants of major companies? And especially as like an executive level, long-time employee level, you just understand, what companies will go for and what they're not. That might give you an unfair advantage in being able to determine which B2B enterprise SaaS companies are going to make it, which ones the companies are likely to adopt, and looking at, being able to see which key metrics let hey, did they just happen to trick one company into doing it? Maybe it's a big name logo that wows a lot of people, but if they try to sell to anybody else who's the same as that big logo, they're going to trip over themselves, and not things are not going to work out. Those are the unfair advantages that are listed inside of a thesis, a strategy, the presentation that someone would make to their LPs. Just making that connection point there. This is the essentially the pitch deck process that founders go through. This is the process that VCs have to go through in order to pitch and create their own fund. So great. Once you pitch that, you've done your investment theses. I might move this over to here. Let's just say that you are able to successfully close, right? The venture firm is able to successfully close, and that means that they can start deploying capital, right? Now, not putting the buggy before the horse here. Um, before you deploy capital, you can't just deploy capital into the ether. You need to be able to generate some form of deal flow. So, what is deal flow? Deal flow is the lifeblood of any venture firm. And there are some strategies, and we'll talk about that next week, that can really help, that founders can do from a deal flow perspective, um, to make themselves more attractive to VCs. But basically, what deal flow is the lifeblood of a venture firm. It's basically the different pipelines that the VC has cultivated, whether in different networking groups that they have, through an angel network that they've cultivated, or through the brand and the prestige of the fund itself. Basically, draw in as good quality companies as possible. In the venture game, there is some quantity that's needed. You need to look at as many deals as possible. But from a quality perspective, being able to generate warm leads from angel investors like myself, who are able to say, "Hey, I really love this company. I've been working with them really closely. I'd like to intro them to you." Right, and these are relationships that VCs try to create, not just with with angels, but also with uh, strong founders that they made investments into. You say, "Hey, your company is a rock star, right? I assume that you've made a lot of friends and you've networked with a lot of different startups that are equally as strong, and maybe behind closed doors they'd say stronger. But they want to be able to cultivate this strong, ever expanding web that is bringing in as many potential deals as possible." And so that's considered the deal flow from for a venture firm, and that's really the lifeblood, because without strong deal flow, the VC is basically looking at a lesser amount of startups to make potential bets on, right? And just the law of and just looking at math, right? The more potential companies that you're taking a look at, the better chance that you have where you're able to invest in strong companies. And so let's just use this kind of deal flow, maybe a lighter blue color than this. That didn't click. So that's barely any different. Whatever. We'll just put that there. So you're really wanting to generate some deal flow there. You might want to be hiring some teams. So maybe first-time fund managers might be hiring some folks, but maybe you're looking at some people to be able to help cultivate the deal flow. So you're just hiring your initial levels of employees. One or two probably in a first-time fund. As the fund, you get into fund 2, fund 3, you can raise larger management companies, and so you're able to have a whole host of analysts and associates and all those different types of folks. So that's another thing there, right? As you hire more people, you start instituting some form of culture at the venture firm as well. And so, being able to understand how, and we'll have more discussion about this next week. Little reminder to myself not to get too excited. Focus. There you go. Jeez. Camera killing me. I'm using, by the way, the new Opal C1 camera webcam, which only works on Mac, unfortunately, MacBook. Has some real bad focusing problems, but looking like you can see the pores on my face because of how good the almost DSLR quality is. But I just got a camera, trying to figure out how to best record with it. But right now we're using this Opal webcam. Been working out pretty well, sans the focus issues. All right. So through the generation of deal flow, Um, let's use a different color here. Nice, nice pink. Um, that you have to start listening to pitches, right? So, listening to pitches, maybe reading some of the initial pitch deck material, right? But we'll just consider that as part of the generating the deal flow. Is that's they're qualified people who are sending you good leads. You look through a forwarded email or some initial pitch deck materials. They like the company. Right, let's bring them in. Come have a chat. A little note that I'll provide here onto the side. Given the remote nature that the pandemic has instituted on a lot of people, a proper term now is Loom, Zoom, Room. So, the Loom, the platform that allows for you to record a pitch, you in a little corner, just like I'm doing now, with a big pitch deck. Very popular format. That a lot of firms basically ask, hey, just record a Loom, send it to us, and if we like what we see, we can skip some of that initial introductory stuff, right, and move directly to a Zoom call where a partner can directly interface with a founder and basically get to know them as a person, evaluate the ability of the founder as much as they can through the Zoom format, as well as have any pressing questions to be answered. And then usually if you have a good interaction virtually, then some might just do a deal virtually, but I think some firms, they like to actually meet the founder and get a measure of the founder in person. So thus meeting in some form of a room, cafe, nice long walks if you're in the valley. Just the general process of how that kind of goes. Cool. All right. So there are some different processes here that you might want to think about that go on. If you've never gone through this, I'll just do a quick detail on this. But generally, if things sound pretty reasonable, the investors are excited and they want to move forward with the company. Not necessarily have a deal yet, but just want to move forward, gain a little bit of understanding. If you want to think about this as like a courting process, right? You're having more and more, calls with people. It might be like more dates, and then you might have like a nice sit down with the person that you're potentially want to have a deeper relationship with, and you might have like a nice deeper conversation. Get to know them, in an intimate setting. Okay, we're gonna scratch that. As that sounded bad. Meaning more so like, hey, trying to understand the person more deeply. Like, hey, what type of food do you like? Stuff that maybe the dates you haven't come across, but would be really good to know about, right? Like, there'd be major pet peeves, deal breakers, all those different types of things. Anyways, I'm just getting to, after a venture firm listens to a bunch of pitches and they really like particular amount of founders, particular amount of startups, moving forward with them, with those companies, they'll generally go through a due diligence process. So that's where associates and analysts at larger firms might be getting involved. They'll be conducting due diligence. They'll be looking at something that's, I'm just providing a little side note here, something called a data room. And so that's usually something that's pretty standard nowadays. The most simplistic form, just a Google Drive with all of the relevant information that a venture firm would want to look at, right? The accounting of a company distilled in a easy to read format, the operating agreement between founders, the cap table, all these different types of materials. When you go through the process, they'll let you know what they want in the data room. The more you do it, eventually you'll learn to keep a very good data room. Um, but clean data room, because it can really help speed up the process of the diligence process, because the diligence process can take up to a month if you're going back and forth with a venture firm. They're asking you for stuff, you're scrambling around to go and look for it. The more you do it, the more you realize what people need, and then you'll just keep those included. Um, Going through that due diligence process, there may, like, hey, if you pass due diligence, everything checks out, your company seems to look like it's not a scam, and it's actually, you haven't lied, and you haven't, put your foot in your mouth and, misrepresented things. Which, if you misrepresent things, that's immoral. If you say it, flat out lie about things, that's, you've broken securities law, and you conducted securities fraud. So don't lie. It's not an investor trying to help other investors by telling founders not to lie. It is literally, you will get in trouble if it's found out that you lied about certain things, when you've been soliciting investment. So, word of warning, right? There's no room for white lies, misrepresentations, because that can get really messy. As a lot of messy startup failures, which will tell you in the past, history will tell you, that you really do not want to be messing around with security laws. So always represent things the truth. You can frame it in ways that'll make you look better, framing things in a good light. But misrepresentations, immoral, outright lies, illegal. But once you pass due diligence, you move on to negotiations. So very often, this is about valuation or potential valuation caps if this is not going to be a priced round. Certain rights that a venture partner or a venture firm might have. Right now we're going through a down period, so we have a lot of talk about liquidation preferences, right? When times are good, nobody cares about liquidation preferences. Immediately when things start falling apart, that's when liquidation preferences are brought out to the table. There might be a discussion about creating an employee stock option pool, an ESOP. There's a lot of different negotiations. That'll probably be its own Founder Sunday School, right? But just know that, not just being able to pick strong startups, or that a good VC isn't just one that can find great startups. It's one that can negotiate great deals as well. It's just part of the process, and being able to strongly negotiate on behalf of your firm so that you have a good deal. That's also important. All right, next step. So you have due diligence, you have your negotiations, and you'll have a partner meeting. So earlier I discussed a little bit more about the partner meeting, but just to kind of refresh it, a partner meeting is a discussion between all GPs at a venture firm, where they basically discuss different deals. Partner may sponsor a deal for a particular discussion at that partner meeting, and generally at 99% of all startups, or at all venture firms, they will need a unanimous consent vote from all partners to invest into a startup. At some venture firms where you have different funds underneath one particular venture fund, unanimous consent amongst 50 partners, some whom are working in different or deploying on different funds. You're talking about like the Sequoias and the Andreessen Horowitz. You might lose the need for unanimous consent amongst all partners, but at a smaller firm where you're just investing out of one fund or two funds, there's a presentation that one partner will make, or sometimes the partner will bring the founder to the partner meeting to kind of give a brief, pitch and maybe ask some questions, that type of stuff. that's where kind of the decision is made to close out a deal. So great. All of these things, but really, you can kind of think about it in left to right, maybe, um, but could go in any direction depending on how fast a VC wants to move on it. Really hope that they don't miss out on this due diligence portion. But knowing in the 2021 bull market, for example, people were throwing due diligence out of the window. Just a long chain of assumption like, hey, I'm investing in their Series B. The Series A must have diligenced them. The Series A, they're like, oh, I assume that the seed investors, diligence them. And the seed investors being like, oh, the pre-seed angel round must have done diligence on them. And then you get to the pre-seed. Do they do diligence? Do they do good diligence? You never know. So that's why it's, the strong fundamental funds will always do good diligence. So let's see here. So, after this partner meeting, we're going to go back to the green color. Everyone always loves seeing the green color here, the money color. And you just close the deal. Pretty simple. Term sheet sent, investments wired in, all that good stuff. All right. And going down. So when you close the deal, does that mean that the VC's done? They just send the money, they're gone? No, in many cases, there's some form of governance participation. So what is that? So what is governance? So that's like a board of directors at a startup. So being able to, venture firms will negotiate to have board seat representation. In some cases, they might want to be passive, so they won't care about having a board seat, but they will want to know that you have a good board in place. And there's multitudes of reasons of that. We'll have a discussion about that probably next week, where we talk about part of the negotiation process and where opportunities may lie for founders to show that they're serious and they're strong, reputable companies by showing that they have good governance. But for venture partners, after they've closed the deal, that does not mean that they are done. They may participate in investment calls, investment meetings with founders. They maybe reading investor updates, and in these investor updates, you might see founders giving out call to actions, and they should be asking their investors to do things on their behalf. Hey, we'd love to generate more sales in this area. Does anybody have any potential leads there? Hey, we're looking to raise our follow-on round. Some of you have expressed interests in pro rata and maybe doing follow-up, but also we'd love new introductions to later stage firms. That's part of the deal flow generation that venture funds have. They might be introducing deals up and hoping that deals are also being sent down. It's good bi-directional. Later stage funds may say, oh, this is a little bit too early, but I know this firm, they're a really good firm. I'll send you over to them and they can look at you for an investment. Hey, you're a little bit later stage than what we'd like, or hey, I've already invested in this startup. They're looking to raise a round beyond what we can take pro rata on. We'd love for you to take a look at this, right? And it's kind of the bi-directional relationship in the deal flow. That's part of kind of, governance participation, but also, the general investor updates that one receives, and thus activities that they might be doing based off of call to actions within investor updates. So great. From these two here, but really mostly these investor updates that they receive from the companies, the venture firms will need to send LP updates. So you need to update your LPs because if you ghost your LPs, they're not going to give you any more money. the two venture firms, right, they're basically going to be bundling up your various investor updates that you're sending from the founder to the venture firm. And they're basically going to bundle those and send that to their LPs. These are the updates they can provide. Hey, look, this startup, it's doing great. Just book some more business, some more big name logos. They're raising a future round. Hey, our positions got marked up. So you're basically on paper making money, right? And those are great updates that venture firms want to provide to their LPs. And ultimately, near the end of the life cycle, on at least the startup end here, from these LP updates over time, you will be distributing wins. And I'll just do it with a cheeky dollar sign here. So distributing these wins. So we talk a lot about liquidity events, exits, and the show's motto is praying for exits. An exit is an acquisition, a merger. Mergers are pretty rare, an IPO, or a company closes. But we're only thinking about the positive ones, the wins. We're really these three here. Two of them are really liquidity events: the acquisition, which was this finger, and the IPO, the singer. Those two things are liquid. Mergers in and of themselves are probably not liquid. Acquisition, someone bought the company, might have paid in only cash in stock, or stock only. If it's stock of a private company, that is illiquid. But if it's cash in stock and it's cash only, then obviously it's liquid. Liquid meaning that it's cash spendable money, liquid assets. Merger. So when two companies combine together, if they're both private companies, the new entity is still private. I don't think it's pretty rare for a private company to merge with a public company, but that generally happens sometimes. Maybe some PE activities going on there. PE firm buys a private company and then merges it with a public company that they own. Spin outs. Company spins out a portion of their business and then wants to merge it with a public company. But those are pretty rare and kind of messy. So I won't go into too much detail on that. The last one is the IPO, where these companies are now listed on the public stock market. Venture firms are usually locked up. It's this thing called a lockup period where they're not allowed to sell shares immediately so that the stock price generally does not tank, right? There's a lockup period also on employee stock options, right? We were talking about the ESOP earlier. Those RSUs, the employee stock, generally also locked up. Usually 6 months period, maybe more, maybe less. It's different from a bunch of different companies, but then obviously if it's on the public stock market, you could distribute shares directly to LPs. You can hold on to the shares and manage it. It's generally pretty rare from a venture firm perspective because venture firms, you're really strong in the private markets. To be able to manage public markets, essentially like a hedge fund, right, or a public market fund. It's a completely different beast, and a lot of venture firms may or may not want to do it, and LPs may or may not want you to do it, or may not want the venture firm to do it. And so, the distribution of the, and the last part is, you may completely liquidate the position. Just say, hey, we're kind of completely cashing it out, selling everything, all the shares, giving you just straight cash. You can choose to reinvest if you'd like, or you can choose for us to not sell. But, it's all the different ranges of options that, either in the initial LPA or, some form of big LP meeting to discuss a potential, an upcoming liquidity event. You may have a bunch of LPs, sign up a quick Google form or whatever, send an email, let us know how you want us to distribute the money, And there's a concept called rolling over, where basically a company based off of this great win will want to allow for these LPs to have an option to roll over their money into a future fund. So basically, hey, I'd like to roll over 20% or some particular amount. I'll keep 80% in that particular asset. Hey, Uber, let's say, for example, I'll keep 80% of my shares of Uber in the public market, and 20% will liquidate that, give the money to you for you to deploy in a future fund. So um, those are the different ways in which LPs can distribute. So kind of providing you some flavor um, on the motivations of LPs and why they invest into venture funds and what VCs are doggedly focused on. So great. Okay, cool. So the last bit that I probably want to talk about, and is maybe more of a spindly one. So let's just make this a curve, maybe. And so, venture fund, when you fully deploy a fund, and that being, the amount that you set out, hey, 80% we're going to invest into startups, and we're going to keep 20% of the fund to invest into pro rata or follow on. Maybe the number is probably more around like 60-40, or a little bit, 60-40, 40 being the amount that you deploy in the startups, 60% saved for pro rata and follow up, because future rounds are probably bigger, hopefully bigger, and not, bridge or now rounds. But, when you completely expend that fund, you raise a new fund. You don't kind of, refill the old fund, right, with more money. You raise a completely new fund. It's just administratively a lot easier. It allows for the venture firm to, update their LPA, or, make changes. You also want them to be discreet from just a promotional perspective to LPs, to show that like your performance improves over time. To be like, hey, look at this is the performance of Fund 1, performance of Fund 2. Well, just think about what our performance is going to be like for Fund 3, right? And so, that's just kind of some consideration there. So, just raising I'll just call it like the nth fund here. So your Fund 1, your Fund 2, your Fund 3. It's kind of the nth fund there. So again, you probably are doing, this again. You're gonna have to create an investment thesis, but you're probably refining it, refining and updating your investment theses and strategy. Just make it look good there. Refining and updating that. You're again pitching LPs again, and hopefully you have some markups within the amount of time that it took for you to deploy your fund. Hey, these seed stage companies, we invested in 10 startups, let's say, for example, 4 of them have raised a Series A, and thus on paper, we've already generated, on paper, this much returns. And so, generally hearing that would be a good reason for why an LP would want to, invest in a future fund that's managed by you. And then kind of the last bit, you're just trying to butter up these institutional LPs. So, the first fund, enough space at the end there? Really? Oh, did I hit enter? There we go. So the institutions, your endowment funds, family offices, those type of money managers there, they have, the large, vast amount of money as opposed to a single person may be able to provide maybe, 50,000 to $250,000, maybe up to even $1 million if they're a rich LP. But, when you're talking to these endowment funds and to family offices, obviously much higher bar to hurdle, to reach. They have much higher standards. May not even invest until like a fund 3 or 4. They need that really strong, solid base. But they're the ones that are able to contribute, the tens or hundreds of millions of dollars, right? And so obviously, just like founders should be, buttering up potential VCs, if they're not raising or they're super early, just keeping VCs in the loop, building strong friendships with them, recommending startups to them, creating intros, anything that you can do to get people into your corner. VCs have to do the same with LPs as they think about raising future rounds. And just like for founders, you may say like, hey, I don't really want to think about like a Series A or some of these later stage, growth stage venture firms. Well, you're going to need them at some point, right? And the sooner you start buttering them up, becoming friends with them, the more that they can help you along, getting in front of investors and all those types of stuff. And they'll be able to follow you on your journey. And, it's easier to invest in, a founder than someone that you're learning about for the first time, right? Ultimately, I think just in both of these cases for growth stage venture firms and for institutional LPs, they are really judging you based off of your performance and your traction and your numbers. It's not more about like you can't trick these people into investing. 99%. I'll say that tricking has probably happened before. It's definitely happened before, but it is generally pretty rare. And there's more the exception than the rule. And, a lot of exceptions make the news. The rule, is just something you live with. And so having lived in this space, it's a lot easier for founders if you, get to know the investors beforehand. Makes it a lot easier to pull the trigger. My personal experience as an angel, super easy to pull the trigger when I know a founder really well, been able to see the work that they're doing, as opposed to someone, sending me a Twitter DM and, I barely have a relationship with them, don't know them at all, and there's really no effort by the founder's part. They just expect to, go through this process over here without thinking that, between the pitch and the initial outreach, probably, just needs to be more human interactions in between. It's just how it works. You're looking to fundraise, you're going to have to be a pretty personable person and network and be able to socialize and, get as many people into your corner as possible. So I think I created a very good summary. Not to speak out of turn, but I think I've created a very good, detailed kind of graphic here of how the VC typical investment lifecycle works. Hopefully, given a peek behind the curtain of the different motivations that a VC has, kind of letting you see like, hey, they're pretty beholden to the LPs. VCs are, and so when you're thinking like, hey, why is it taking so long, or like, why are they not investing in me as compared to other people or different opportunities, or like, why is suddenly, a bunch of VCs are suddenly interested now? But 3 months ago they were super not listening to anybody. They weren't taking any more pitches. Hopefully, I've given you a little bit of a peek behind the curtain. So that really concludes this week's Founder Sunday School. Really, let me know if the Excalidraw platform, this drawing tool, I guess I didn't draw that much today because I was just using text. In the future, maybe doing some more interactive stuff. I'll do a little bit of drawing on the iPad, but for right now, I think the text and the text boxes were pretty sufficient there. Maybe in the future, when I go through some practical examples on Founder Sunday School, we'll be able to implement the drawing tool a little bit more. Especially considering my love for the whiteboard. Unfortunately, the whiteboard was a little bit too glary, and the Opal camera, which I was using before, had some focusing issues that was pretty evident in some of the footage that I was shooting. And so really, sitting down, not moving too much, hiding my gut, which looked pretty big in those full person shots. I'm working on it, working on it. I think that this is probably a really great, interesting format. So I hope you guys enjoyed the episode. Went a little bit long, but hopefully a lot of really good nuggets. Be able to break down some shorter clips from this episode. I think it's going to be really great. And so, yeah, please feel free to like, subscribe, provide some comments down below. Love to get some reviews, get some suggestions on how to improve this format. I'm really liking doing this. And so until next Sunday.